Welcome back to another video of Money with Ben. My name's Ben, and this is the show where we talk all things finances, accounting, taxes, and just understanding your money better. So in the previous video, we talked about how in order for you to get a better grasp of your business or of your personal finances, you need to understand the A equals L plus E formula. And today I want to emphasize that. If you want to get better in your business or your personal finances, you need to understand the A equals L plus E formula. Assets equals liabilities plus equity. And if you want to go a little bit more detail of what an asset is, a liability is, or equity is, go back to the Money with Ben first episode, all right? But I want to add some practical application to it because you might be thinking, okay, I know what an asset is. I kind of understand what a liability, maybe understand what equity is, but okay, how do I apply this to real life? How's this help me? Well, the good news is when we as accountants are trying to help our clients understand their business better, we provide them with a special report that is essentially the A equals L plus E formula visualized. It's called a balance sheet. And the reason we call it a balance sheet is because in order for A equals L plus E to work, both sides of that equal sign need to be the exact same number. Like for example, 2 equals 1 plus 1. The reason that equation is correct is because if you add 1 and 1 together, you get 2, and we all know 2 equals 2. Just like how 1 plus 1 equals 2, in the same demeanor, 2 equals 1 plus 1. And what's happening is both sides of that equation, both sides of the equal sign, is balanced because it has the exact same number when you add everything up together. That brings up another interesting point. Many people ask, okay, I don't want to be an accountant, I don't want to do finances because I'm not good at math. Well, let me provide you some ease of mind, for lack of a better word. If you want to be an accountant, and it turns out if you want to run a business or run a personal life, you need to know accounting. If you want to be an accountant, all you need is the math that you learned from 5th grade. So if you know how to add, you know how to subtract, you know how to multiply, you know how to divide, guess what? You can be an accountant. And you might be thinking, wait, are there percentages and stuff like that? Good news is there's calculators for that. You're allowed to use a calculator with your own business. You're not going to get an F for not having a calculator, all right? But you need to understand this. So with the balance sheet is just a sheet of paper, hence the word, that it is divided into 2 sections. One section lists all the assets that you have. So it lists all the bank accounts you have, it lists the properties that you have, it lists the short-term investments or the stocks that you might have, it shows the names of the people that owe you money and the inventory that you have, all the equipment, all that stuff is listed in the assets section. And they total all those numbers up and they give you one big number called total assets. And then the second section has the liabilities and the equity. So they add up liabilities, all your bills, all your mortgages, everything that you owe. Because you got to remember, liabilities is what you owe, assets are what you have. They add up all those liability numbers together and you get total liabilities. And they do the exact same thing with equity. They look at how much money did you invest personally, how much money did you make in income, and how much money did you make in income in the previous periods, or in terms of our previous years. Add those things together, you get equity. And you know that it balances when the number of total liabilities plus the total number of equity. If you add that number together, if it's the same as the total assets, it balances, therefore it is a balance sheet. Now, why do I emphasize this so much? It's essential that you as a business owner or you as an accountant can have a snapshot of your company at any given point in time. And the balance sheet is exactly that. So when you're understanding the balance sheet, it's almost as if you're taking a look at your business. You take a camera and you just take a picture. You're just taking a picture of what your business looks like. It's kind of like when a doctor takes x-rays. They're trying to have a snapshot in time to see how is your body looking like on the inside. And with that snapshot, they can determine, we can see this is normal, this is normal, this is normal. Oh wait, we see a fracture here. Let's see what we can do to take care of it. And that's what a balance sheet does. A balance sheet gives us a pretty interesting snapshot. And it looks at your body of your business to see, okay, this looks good, this looks good, this looks good. Wait, hold on. This part looks kind of broken. Let's see what we can do to fix it. Another way to look at a balance sheet is like reading a book. Because when you read a book, you have chapters and you have different parts of the story. And what's interesting is that the balance sheet is almost as if you're reading a chapter of a story. And yes, the balance sheet is looking at your past many times. So it's looking at a history book, you could think of it. So chapter 1 could be, all right, let's look at assets. Chapter 1, you have cash of $10,000. You might think, okay, that's great. And this is unfortunately where many small businesses stop. They stop, oh, I have cash of $10,000. I'm good. Let's move on. Let me just do my business. Let me just work on my real estate. Let me just work on my art business. Let me work on my selling of properties. Let me work on my law firm. Let me work on all those things. I just know I have cash in the bank. I'm good to go. Don't need to worry about anything else. Well, that's just one chapter. You have a whole novel here at your disposal and you're just reading one chapter. Cash is important, but that's not everything. You need to read on. So with chapter 1, you might have, okay, chapter 1, $10,000 in cash. Great. What does that mean? Let's read forward. What if chapter 2 is credit card debt, $20,000? Suddenly, whoa, now you have a little bit more context. If all you saw was $10,000, you might think that's good, you might think that's bad. But now you see chapter 2, credit card, $20,000. Now you're getting a bigger picture than you had before. You're seeing your company might be in a little bit of jeopardy, because if you have credit card debt of $20,000 and say they want your money right away one day, are you going to have enough to pay them back, right? So that's something that you work on. So whenever we see cash, whenever we see assets and liabilities not having a good ratio or good relationship with each other, especially when your short-term debt is higher than what your short-term assets are, we consider that to be a red flag. There'll be a little fracture in the business. So it's vital that you understand the balance sheet. And we talked about this a little bit before in the first episode. Another thing that you need to know when it comes to a balance sheet is that your balance sheet is factual. It is your reality. It is not something that you can argue with. You can deny what's on the balance sheet, but the balance sheet is going to tell you straight up, look, this is how much you have. This is how much you owe. This is how much of this whole business belongs to you. Does it belong to you? Maybe. We don't know until you look at everything. When it comes to your balance sheet, the goal, because I can tell you what your reality is, but you need to have some type of goal. And that's the great thing about accounting. Once you know your past, now you can figure out what your future can be, and then you can make decisions based off of it. And we'll continue on with this as we go forward. But you need to understand that when it comes to improving your business, the goal is to have more money belong to you. That's the ultimate goal. Some people think the goal of the business is to just make the business big. Unfortunately, it's very easy to make the business big. But what's difficult is to make the business that belongs to you big. What you want to do is to make your equity grow. That's the goal. Not just equity, but the part of equity that you retain. You want to earn as much as you can. You want to be able to retain as much as you can. Have more of those assets belong to you. Because I can get $1 million house right now, but it might come with $1 million mortgage. Then that house doesn't really belong to me. See the issue here? You need to make your business have more assets that belong to you. And we're going to continue with this because the balance sheet is just one report. It's just one report. And we're trying to figure out, all right, here's your reality. But you might be asking yourself, okay, it tells me how much I have, but how do I figure out what did I make? And that's an important question too. And we're going to discuss that in the next episode of Money with Ben. These couple of episodes, they're just going to be a foundation letting. It's not going to be super exciting, but just like concrete. Concrete isn't super exciting, but it does everything in order to keep a house secure. So the same way, this part may seem a little bit uninteresting at some points, but it's going to be extremely foundational if you understand, all right, if I want to make my business better, I need to understand I need not just assets. I don't need to just have more stuff. I need to have more stuff that belongs to me. That's actually to give me money that's going to belong to me. Until then, that's been Money with Ben. My name's Ben, and I'll see you next time.